Hey everyone, welcome once again to Daily's Guidance. Friends, today we are going to take one more topic on security analysis and portfolio management, that is efficient market theory or efficient market hypothesis. Friends, we are continuing our discussion on security analysis and portfolio management, and in our previous videos we have seen a couple of things about securities, risk, return, its calculation and several other aspects. Today in this video, we will be discussing or we will be knowing what is efficient market theory or efficient market hypothesis. So let's begin. So friends, we have seen in the previous discussion that there is something called technical analysis and fundamental analysis. So there are two types of analysis that we have already seen. So one is the technical analysis, the another is the fundamental analysis. Friends, this type of analysis is done in order to have an understanding about how the stock prices are likely to behave in future. We are trying to know how is the economic condition, the industry condition and the company condition under the fundamental analysis, whereas under technical analysis we are trying to see the past trends, the historical, the trend of the price data. That's under technical analysis. So for the detailed video, do watch the video that I have made for technical and fundamental analysis. The link is already there in the description box. Let's continue our discussion. So friends, we are at point 0 and we want to know how the price is going to behave in the future. We want to know, we have seen the trend in the future and we want to know whether the price is going to behave in some trend that we have experienced already in the past. But there is one point of, or you can say there is one school of thought, or there are some theorists which believe that, the theorists who believe that the price data doesn't follow any trend. So the prices are simply random. That means the price data do not have any trend, and if you think that you are going to study the trend and to predict the future, then you are wrong. Okay, there are theories, they believe that if you try to find out how the price is going to behave in future knowing the past data, then you are doing something wrong, because according to them, the prices follow a random trend. The prices are random and therefore there is no trend as such. So doing any kind of fundamental or technical analysis will not help you to make any kind of extra profit, right? So if technical and fundamental analysis is not going to give you any benefit, then why you would do that? And why it will not benefit you? Because they believe that the stock prices are simply random and they have no trend, no pattern, and you cannot get any clue out of it. So this is the major focus or focal point of the efficient market theory or efficient market hypothesis. Now I will be discussing some points which will make this theory more clear. The first thing is that about the efficient market theory is that they said the market is efficient. The market is efficient. So when I say market is efficient, what does this mean? Market efficiency means that the prices that is reflected, okay, the price of the security that is reflected in front of us reveals all the information. Okay, the price reveals all the information. So let's understand that what does this mean? Price reveals or reflects, all the information. All information. What does this mean? This means that if you are an investor A and I am an investor B, and suppose we are interested to invest in company X, and suppose there is a good news that is likely to come out, okay, the good news which is coming from the company X, then this good news, the moment it comes, it is immediately adjusted with the price, because you know with good news the price will go high and high and high. So there is in fact no time lag between the information to come in the market and the price to get reflected. So immediately the price reflects all the available information, good or bad. Now that means the price reflects all the information. Now what will happen if the price does not reflect all the information? Or in other words, if the price takes time to adjust with the information, If the price takes time to adjust with the information, then there is a scope for people to make extra profit. Because I know that suppose for some reason Mr. A comes to know that there is a good news which is coming in the market, but B does not know this. If A knows and B does not know, A has got informational priority, or you can say informational advantage. A is enjoying the informational advantage, but B is not able to enjoy the advantage. As a result, A can immediately buy more and more shares so that as the price goes high, he can sell it. But B has not done that because B did not receive the information. So, B has not received the information, A has received the information. That's why A could make some extra profit because he took the advantage. But in the efficient market, we believe that this situation will not come at all because the price will immediately adjust with all the information. Immediately, there is no time lag. These things will not come. The price immediately reflects the information, right? The second point that is coming in fact from the first point itself, that no one can make extra profit. That means A cannot make extra profit because whatever information A has, the same information B has at the same point of time. So there is no such possibility that anyone can beat the market. No investors can make extra profit and no investors can beat the market. So there is no possibility to make any extra profit. No extra profit is possible if the market is efficient. So when the market is efficient, there is no informational leakage. There is adjustments of the information immediately with the price data, and as a result, there is no possibility that one will get the advantage, the other will not. Therefore, there is no chance that anyone can make any extra or can beat the market. Okay, so these are the 2 points. Second point, as I have already told, that the prices are random. So when I do technical analysis and fundamental analysis, and if my analysis is very perfect, okay, I have perfectly analyzed, then it is quite sure that I will be able to make profit. I can beat the market because my analysis is perfect as against those who could not make the analysis that perfectly. So if someone is not able to do the analysis perfectly, but I am able to do the analysis perfectly, I can beat them. Okay, but the theory says that this is not at all possible. Why? Because the price has got no trend. What will you study? How will you do chart analysis when there is nothing to understand from the chart? So there is no place for fundamental analysis and technical analysis if the market is efficient. Efficient market means there is no chance that anyone can beat the market. It means that the price is already all the information with it. It means that there is no necessity for doing any fundamental or technical analysis. And lastly, that I started with, is that the share prices are random. Share prices or stock prices are random in nature, and that's why there is no pattern, there is no trend that you can find from the stock prices. And that is why, friends, this theory is also known as the random walk theory, right? So all that I can say about the efficient market theory is that a market efficiency, if somebody wants to define what is market efficiency, then you can say market efficiency can be defined as a form of market where the price reveals all the information, or the price is adjusted with all the information very instantly. And there are no chances that anyone can beat the market or can make extra profit. And there is no place for doing any fundamental and technical analysis, as because the stock prices are very random, right? So friends, you have also known from one of my previous video that there is something called the market value and the intrinsic value. Market value of the security means the price at which the stock is being traded. Okay, the current market price. Suppose the current market price is 200. Okay, it can be any denomination, say rupees 200. And if you find that its true worth, its book value, the true worth of the security is 180, then I would say the stock price is overvalued. Overvalued means the stock price is reflecting a value which is more than its true worth. Okay, true worth means how much benefit that stock price can give to its stakeholder or the shareholder, right? So I can see here that the market value is greater than the intrinsic value, and that's why I come to the conclusion that the security price is overvalued. Or if there is another situation where I say that the market value is 180 but its intrinsic value is 200. In such a situation, I can say that its market value is not reflecting its true worth. That means the security is undervalued. So when I say the security is undervalued means the security deserves a higher value. Its worth is more than what it is reflected in the market. Now friends, that means in this case our intrinsic value is more than the market value. Now these thing happens, this maladjustments or imbalances happens in the short run. But in the long run, both will be equal. MV will be equal to IV. The market value and intrinsic value, they tend to be to balance. They tend to equate with each other. Now friends, now that means if I know the security price is overvalued, I can make some extra profit, right? Or if I know, or I can beat someone who doesn't have this information. Or if I know the security price is undervalued, I can also take advantage of it because I know very soon the price will rise. So I will buy more share, and the moment the price has increased, I will sell them off. Here, I will sell all my share because I know that the price is likely to come down. So this type of situation again is not possible under efficient market because efficient market believes that the securities are correctly priced, correctly priced. So that means your market value is exactly equal to the intrinsic value. Right? So I hope I made sense by saying that securities are correctly priced means there is neither any overvaluation or not any undervaluation. Both the security prices are the intrinsic value and market value are equal, and therefore there is no chance that someone can have this possibility that he will buy and he will sell considering the fact that the securities are under or overvalued. So friends, these are some of the features of efficient market. So I hope you all understood what is a market efficiency. Friends, I do have a full-fledged video on efficient market hypothesis. You may watch it. The link is again there in the description box. Let's meet again in the next video and find out what can be the different forms of market efficiency. Thank you for watching. Goodbye.